Have you ever checked your credit score and felt your stomach drop? One day you're sitting comfortably with a healthy score, and the next, you've lost 30, 50, or even 100 points seemingly overnight. No missed payments, no major financial mistakes, just a sudden decline that leaves you wondering what happened. If that sounds familiar, you're not alone. Every year, millions of Americans experience unexpected credit score drops, and the truth is that most people don't understand what's really happening behind the scenes. Today, we're going to uncover the real reasons your credit score can suddenly fall, and, more importantly, exactly what you can do to fix it. Let's start with an important fact. Your credit score isn't just a random number. It's a mathematical calculation based on information found in your credit reports. Most lenders use FICO scores, which range from 300 to 850, to determine how risky it is to lend money to you. The higher your score, the more trustworthy you appear to banks, mortgage lenders, and credit card companies. But because your score is constantly being recalculated as new information appears, even small changes in your financial behavior can have a surprisingly large impact. One of the most common reasons for a sudden drop is an increase in credit utilization. Credit utilization refers to how much of your available credit you're using. Imagine you have a credit card with a $10,000 limit, and you typically carry a balance of around $1,000. Your utilization rate would be just 10%, which is considered excellent. But let's say you make a large purchase and your balance jumps to $5,000 before the statement closes. Suddenly, your utilization rises to 50%, and your credit score could take a noticeable hit. The surprising part is that you don't have to miss a payment for this to happen. Simply using more of your available credit can make lenders view you as a higher-risk borrower. Another major cause is a missed or late payment. Even one payment reported 30 days late can significantly damage a strong credit score. Payment history is the single most important factor in most credit scoring models, accounting for roughly 35% of your FICO score. What's frustrating is that many people don't realize a payment was missed until they see the damage. Automatic payments fail, bank accounts become overdrawn, or a bill gets overlooked during a busy month. Once a late payment is reported to the credit bureaus, the impact can be immediate and severe. Credit score drops can also happen when a lender lowers your credit limit. Let's say you have a credit card with a $10,000 limit and a balance of $2,000. Your utilization is only 20%, but if the issuer suddenly reduces your limit to $4,000, that same balance now represents 50% utilization. Even though your spending hasn't changed at all, your score may decline because your available credit has shrunk. Another hidden factor is applying for new credit. Whenever you apply for a loan, mortgage, auto loan, or credit card, the lender typically performs what's called a hard inquiry. One inquiry alone usually doesn't cause much damage, but multiple applications within a short period can add up. To lenders, several recent applications may signal financial stress or increased borrowing risk. That's why some people see their scores dip after aggressively shopping for credit cards or financing options. There's also the possibility of errors on your credit report. This happens more often than many people realize. Incorrect late payments, accounts that don't belong to you, duplicate debts, or even identity theft can all trigger sudden score declines. That's why financial experts recommend regularly reviewing your credit reports from all three major credit bureaus: Experian, Equifax, and TransUnion. If inaccurate information appears on your report, disputing the error can often restore lost points once the issue is corrected. Now let's talk about how to fix a declining credit score. The first step is identifying the cause. Check your recent credit reports and compare them to previous activity. Look for new accounts, higher balances, late payments, or reporting errors. If utilization is the problem, focus on paying down balances as quickly as possible. Many people are surprised to discover that simply reducing utilization below 30%, and ideally below 10%, can lead to meaningful score improvements within a relatively short period. If you've missed a payment, bring the account current immediately. The longer an account remains delinquent, the more damage it can cause. While the late payment won't disappear overnight, establishing a pattern of on-time payments moving forward helps rebuild trust with lenders and gradually strengthens your score over time. If you discover reporting errors, file disputes directly with the credit bureaus and provide supporting documentation whenever possible. Federal law gives consumers the right to challenge inaccurate information, and correcting errors can sometimes produce one of the fastest score recoveries available. It's also important to avoid closing old credit cards unnecessarily. Many people believe closing unused accounts improves their finances, but it can actually reduce available credit and shorten the average age of accounts, both of which may negatively impact credit scores. In many cases, keeping older accounts open and active with small, manageable purchases can be beneficial. The good news is that a credit score drop is rarely permanent. Credit scores are designed to reflect current financial behavior, which means positive actions can gradually outweigh past mistakes. Whether your score dropped because of high utilization, a missed payment, new credit applications, or reporting errors, there is almost always a path back to recovery. The key is understanding what caused the decline and responding strategically rather than emotionally. At the end of the day, your credit score is more than just a number. It can influence mortgage rates, car loan approvals, credit card offers, and even certain employment and housing opportunities. That's why monitoring it regularly and understanding how it works is one of the smartest financial habits you can develop. A sudden drop may feel alarming, but when you know the rules behind the system, you gain the power to take control, rebuild your score, and strengthen your financial future.